if it's let's say $1 million, I just thought about keep it simple. But is it mostly for residential, like single family, or could it be for a big apartment?
It could be, the biggest one we did is 125 million building in LA.
Oh, in LA. Wow.
Yeah.
Wow. Wow.
It was, a big skyscraper.
I
It can literally be almost any asset. But the key thing is that the capital gain has to be more than about 500K before it's financially worth it.
I see.
Yeah. And then the only other thing is the trust is a 10-year trust. And at the end of 10 years, you can choose for it to lapse and pay the tax, or you can flip it to another trust. And you can do that as many times as you want. It's also inheritable.
I see. So it is actually like a 1031 where you have to pay tax. It's just deferred.
Right. Exactly. Very similar to 1031. And basically, the trustee is acting as the intermediary, just like in a 1031, it has a QI, right?
Right.
So the interesting contrast is, you could do business with me or you can do business with the IRS. Mm-hmm. So if I sold, my $10 million building, I'd probably be looking in California at about 40% in taxes.
Yep.
So that'd be $4 million.
Yes.
You do business with me, it would be 1.25%. So what would you rather pay, 40% or 1.25%?
I know. Makes sense. Hey, I mean, in simple terms. So how, when did it start, this whole thing? It's not that common knowledge, I think.
No, it's not. So the attorneys that basically put this product together is a proprietary product. They've been in business for over 24 years. They've been audited 20 times by the IRS. They never lost a penny of a client's money.
Wow. I see. Okay.
And they have over 3 billion in trust assets.
Oh, is that right? 3 billion. Are they like in the California area, or are they like?
So they're around different parts of the country. So they're basically in Kansas, Missouri, and New Orleans.
Oh, okay. New Orleans and Kansas.
But they actually do business in any U.S. state or territory.
I see. And it's all, like you said, IRS even questioned because, IRS wants their piece of the action.
Yeah.
They want the taxes, and they want to make sure that, legally it's all bound. And
right.
That is, it's proprietary. So they were able to put together this whole mechanism together.
Yeah.
And it's been tested the time, $3 billion, right?
Yep. In 24 years and 20 audits.
Oh my gosh.
So the other thing is when you basically buy this particular trust, when you buy into it, you also, it includes audit insurance for the life of the trust, which means that if for some reason you are audited, the tax attorneys will defend the instrument.
Totally. Wow. And then it has to be over 500,000 gain, you said.
Yes.
I heard that, I see. Wow.
Now, what's important is this is just one of 13 different strategies we have. So, for example, 1031 is one of them. There's forward exchange, reverse exchange, improvement exchange. We actually work with multiple 1031 exchange accommodators because we know which ones are the right ones to use depending on what you're doing. If you're doing a reverse exchange, we've got one who's really good at it. If you're doing a straightforward exchange, we've got one that can have you up and running in 12 business hours.
Wow.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my Apartment Syndication Made Easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you.
Yeah. So in addition, you were talking about the Delaware Statutory Trust.
Yes.
We do some pretty interesting things that other people don't really know about with the Delaware Statutory Trust. So if you took a business, let's say you had a $5 million business you wanted to sell, or actually an investment property that you wanted to sell. And essentially you were looking at wanting to get the maximum amount that you could to basically put into the next property. Now you've owned this business for, let's say, 20 years, or sorry, this investment property for 20 years. And let's say you had an original mortgage of our original purchase price, $5 million property, let's say original purchase price of $1 million. And now you've had depreciation over 20 years, straight line depreciation. You got about 500K left in basis, right?
Yeah.
And then you have basically depreciation recapture of about 500K. Well, in the meantime, I got a loan for $2 million. Now I go to sell, what happens? I have a $1.5 million of my loan is over my basis, which means I have to pay $2 million loan back, but I'm being taxed on, $4.5 million. That's money I don't have, right? So once I pay the taxes and I pay back the mortgage, I'm going to have, maybe a little over $1 million left. You go, oh my God, what happened to all my money? Well, this is a situation where you can go into a 1031 exchange to avoid, the capital gains tax. However, you're still going to have to pay tax on that depreciation recapture, right? Wrong. Because what we can do is we can purchase a Delaware Statutory Trust. Now, what people don't understand about a Delaware Statutory Trust, let's say it has a 50-50 loan to value ratio. If the Delaware Statutory Trust, if you put in $100,000, 50% of actually, if you put in a purchase of $100,000, you're actually buying $100,000 in mortgage and $100,000 of investment. So you're actually getting $200,000 against that $500,000, or sorry, that 1.5 million mortgage over basis. So you can basically buy down the mortgage over basis with deferred sales trust, or sorry, with Delaware Statutory Trust. Now there's special types of Delaware Statutory Trusts that are zero coupon. There's a really good one right now that Amazon is running, that it's an Amazon warehouse in the Midwest, and it's an 85% loan to value ratio. So that means I put in, or sorry, it's 80%. If I put in $20, I'm buying $80 worth of mortgage.
Holy cow. Wow.
So for a very small amount, I can buy down that mortgage, or sorry, that depreciation that I otherwise was going to pay tax on. People don't understand these strategies. So this is just a couple of, literally hundreds that we've done.
Wow. No, thank you so much for really enlightening. I mean, and kind of sharing all these golden nuggets. I know everybody probably listening in my audience and like that, we want to save taxes. We want to legally as is due, of course, cost segregations and this and paper losses and passing through LLCs, those are very popular. And this is very different and nice. Now, charity, so nothing connected with the charities, right?
We also do charitable giving. So you can basically do, an islet with a charitable trust. It's called a charitable remainder trust. And the idea is that you can put it, if you're charitably minded, we definitely have partners we work with that can help you basically construct everything to do with setting up that investment to a charity. And what a charitable remainder trust will do is allow you to also generate a lifetime income. And then when you pass away, the remaining funds go to the trust. So what's kind of cool about that is you get an immediate tax write-off when you put the money into the charity. Plus, you're going to get some income along the way. And then the charity still gets paid at the end.
I'm with you. It's like one way, right? You pay 500,000, $1 million, and then it just given to the charities that you desire.
Exactly.
But you get that big deduction, definitely.
Yeah. And so charitable, if somebody's charitably minded, that's really good. The difference between that and like a deferred sales trust and the charitable remainder trust, you put the money in, it's no longer your money. And as soon as you draw an income, you have to take a certain percentage or a certain dollar amount, and that's it forever.
I see.
With a deferred sales trust, it's your money in the trust. And you can actually change the amount of money that you're withdrawing over time.
Awesome.
You can even go after withdrawing the original principal if you want to.
Beautiful.
Yeah.
Wow.
So it all depends on what you want to do.
Yeah. Chris, anything else you want to share with the audience? I know. And then also, how can people reach you, brother?
Sure. Oops, sorry, got disconnected.
No worries.
Yeah, so our website is defertax.com.
Okay.
Our 1031 exchange website is called startandexchange.com.
I see.
And, we have the ability, if you want to start an exchange and you're worried that, well, what if I can't identify in 45 days because it's so hard to find properties?
Yes.
If you start it with us, we can actually save your exchange and roll it over into other tax deferred strategies, even though you entered into a 1031 exchange, which a lot of exchange accommodators can't do.
I see.
But in addition to that, you can reach us at through defertax.com and our contact link. You can set up an appointment with me by going defertax.com/Chris.
Okay.
Or email me at chris@defertax.com.
Excellent. Thank you so much for really sharing great nuggets. And
absolutely.
Thank you so much. And, for coming and hanging out with me. I appreciate that.
I really appreciate it too. And when I saw the presentation that you had did elsewhere, I knew this is the guy I wanted to know. Thank you for having me.
Oh, thank you. It's such a pleasure. You have a wonderful afternoon, and we'll talk to you again.
All right. I look forward to it.
Bye-bye.